But they both had MS at the top, right?
Correct. So money supply, money demand. Now we're going to look at how the Federal Reserve making money supply changes will affect the interest rate and investment based on reflecting off of the investment demand curve. So we have our nominal interest rate and at equilibrium where money supply and demand cross. We're going to bounce that over and down. So we have that level of investment at that interest rate. This is how much money we have. That's the quantity of money. So we have this much money supplied by the Federal Reserve Bank, this much money demanded, either asset or transaction, by the public. And so at that point, we know what our interest rates are. Interest rates are the price of money, the cost of borrowing, or what you get from putting money in a savings account. So the nominal interest rate will also be on the investment demand curve. Remember, the investment demand curve is all the borrowers that are out there, kind of like a pool of borrowers, and at a certain interest rate, they're either going to borrow or not. So now, if there's an increase in the money supply. So if there's an increase in the money supply, that's big bucks, right? So if we have big bucks, now it's going to be more money available. If there's more of something in the same amount of demand, I'm going to shift this to the right. And if you get confused, just remember, interest rates are a price. If there's more of something available with the same amount of demand, the price will drop. It's a surplus. So now, where the new money supply crosses, forgot to shift that to the right. Need my arrow right there, showing a rightward shift. So now this new place, where the same amount of people are wanting money, there's more money available. So I know that will make interest rates drop. So I go from I to I1. So money supply goes up, interest rate drops, and at low interest, people will want to borrow, so investment will go up. So now I prove it by going over, hitting that curve, and it bounces down, it reflects. So I know that I have more investment at a lower interest rate. And then what you would do from there is maybe draw aggregate supply and demand and show what GDP and price level do, or do a Phillips curve with unemployment and inflation. There's some options that could come off of this. But knowing the money supply goes up, all these things could change. So with monetary policy, remember all those tools they have. Buy bonds makes big bucks. Reserve ratio, lower that. It makes more excess reserves. Change the discount rate of the Fed funds rate to target lower interest rates. All of those can be done. The tools of monetary policy are all done to influence this in order to change this to make the economy go or make it slow. So this would be an expansionary policy. Okay? So on the opposite side, what's happened in the last couple weeks? We've had some changes with the Federal Reserve Bank trying to be a little bit contractionary with so much expansionary fiscal action we have. So if the money supply were to decrease, now you don't have to draw these on the same graph, but I'm doing it just to show you the differences and to be lazy. So I know if money supply decreases, it's going to shift to the left. And where money supply crosses money demand at this new point, I got less money available and the same amount of demand. That's going to be a shortage that makes prices go up. So I know that the price of interest will increase, or the price of money is interest. So now I can take this all the way over, I bounce it off or reflect it off the investment demand curve, and I prove that at a higher interest rate, there is less borrowing done, less purchase of capital, less investment. So money supply decreases, that's going to make interest rates increase, that's going to make investment decrease. So these are my reflections of the investment demand curve. So interest sensitive consumption, that means borrow and buy capital like a new truck, a new computer for your businesses. That will slow economic growth. So when investment changes, it either adds to growth or takes away from growth. So you could shift a PPC outward, you could shift long run supply to the right. There's a few options. So usually on a long FRQ, you could get something like this, and it will lead you to aggregate demand or Phillips curve or something like that.